Just to take a really simple example, let's say that there was, the bar of gold in front of us, and I wanted to sell it to you, and you wanted to buy it. We would go back and forth over the price. We'd agree on a price, and we'd sell that bar. But what if we had one bar of gold?
In this video, Jim Rickards highlights the dangers of derivatives and systemic risks in the financial system. Learn why understanding off-balance sheet liabilities is crucial and why waiting until the crisis hits to buy gold might be too late. Don't miss this urgent warning.
I'll just make up, let's say a 1 ounce gold coin, so $1,400. And I said, okay, Lynette, I could sell you the 1 ounce gold coin for $1,400, but why don't I sell you 100 ounces? I only have 1 ounce sitting here, but we'll make the other 99 a paper contract. And we'll agree that either I pay you or you pay me, depending on where the price goes from here. So bear in mind, we only have 1 ounce of physical gold, but we do a deal on 100 ounces, 99 ounces of paper gold and 1 ounce of physical gold. Well, that's a much bigger deal, a lot more money involved, a lot more profit and loss for either one of us. But there's still only 1 ounce of gold. The other 99 is the derivative. So a derivative is just a paper bet. It's a paper bet based on some underlying with no limit as to how big the paper bet can be. Now, I'll give you another concrete example. And I remember in 2007 when the mortgage crisis first hit in the spring, and then there was a money market crisis in August, and that's when Jim Cramer had his famous meltdown with Aaron Burnett on CNBC. They know nothing, but the point being, that was the beginning, and then it came to a head over a year later with Lehman Brothers in September 2018. But when it first started, there were some very smart people, and I would put, Ben Stein and others. He's an economist and he's a comedian, actor, but also an economist. And a lot of other people said, look, there are $1 trillion of subprime mortgages, and that's about what there was with Alt-A. That's another kind of subprime, but let's say $1 trillion of subprime mortgages. In the mortgage market, 5% is a huge default rate. When default rates get to 5%, people are, kind of panicking. He said, let's get crazy. Let's assume a 20% default rate. It never got that high, but just assume it. Well, 20% of 1 trillion is 200 billion. So he said, even if this thing gets totally out of control, we'll have 200 billion in losses, which was about the same in real terms as the S&L crisis in the 1980s. That was about 135 billion of losses. So adjusted for inflation, it would be $200 billion by 2007. And Stein said, well, we survived the 1980s. We can survive this. It's about the same. What he was missing was that, there were $1 trillion of mortgages, but there were $6 trillion of derivatives on the mortgages, on the same mortgages. And so 20% default rate, it wasn't 200 billion. It was 1.2 trillion of losses just to get started. And then the panic went on from there, and the losses were ultimately in the scores of trillions. Right. But the point being, you cannot look at bank balance sheets. You cannot look at futures contracts. You cannot look at any known quantity and understand the risk without understanding how much is off balance sheet, how much more of the same thing, the same kind of bet. And banks do not put derivatives on their balance sheet. And I've had this debate in chapter 8 of the book, chapter 8 of Aftermath. I talk about a private briefing that I had with the board of directors of Morgan Stanley and their CEO, James Gorman. And I said, well, first of all, a couple things. Number one, your derivative book might be smaller, it actually was, but that's because so many of the derivatives were moved over to the clearinghouses. They created these clearinghouses after 2008. So now, two banks do a derivative trade, and they take it and they send it to the clearinghouse, and you put it on the balance sheet of the clearinghouse. You didn't make the risk go away. You just moved it to a side pocket. So, maybe Morgan Stanley or Citibank's balance sheet has fewer derivatives, but it doesn't mean there are fewer derivatives in the system. They've just been put over in the clearinghouse. Who's going to guarantee the clearinghouse? Again, Morgan Stanley's capital base may be fine, at least in most circumstances, but who's backing up the clearinghouse? Well, the answer is the members, which are the banks. So if the clearinghouse gets in distress, they're going to turn to their members and say, hey, give us capital, at a time when the banks are like, oh, we can't do that because we need all the capital we can get. So first of all, you're undercounting derivatives when you ignore the clearinghouses, number one. Number two, and this was the point I made, I said, look, As a bank, you may be stronger, but you're part of a system, and the system is more vulnerable. And if the system goes down, you go down with it. I don't care how strong your balance sheet is. You're part of something bigger, and if that collapses, you collapse too. And I said, look, you're running a bank. You can't take responsibility for the whole world. That, in theory, is the responsibility of regulators and central bankers and others. But they don't know any more about risk than Wall Street does. I mean, everyone's ignoring the risks or not computing the risk properly. So I say, yeah, maybe your bank's more sound, but you're not counting the clearinghouse and you're ignoring systemic risk, which is bigger and more dangerous than ever. The warning signs are all over the place. You just have to understand them, incorporate them, connect the dots, and then see how it plays out. And it's not just one path or multiple paths, but they all sort of end up in the same place. And then I bring it full circle. I say, well, if this is coming, and it is, what are you waiting for? Why not get ready now? When I've had people say, I'll be half facetious, but it's kind of true. They say, Jim, I hear you, I agree with you, but I'm making too much money in the stock market. Could you call me at 3:00 the day before the crash, and I'll sell my stocks and buy some gold? And I said, well, first of all, I'm not going to know the day. I can tell you it's coming, but I don't know the day. And if I did, I'd probably be a little busy myself. But the point is, when you most want your gold, when the panic hits and everyone like, get me out of stocks, get me out of money market funds, I want gold, you're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Right. It is, because there's, you were talking earlier about people selling their stocks and their money markets and all of these and buying gold before the crisis hits. But will there be any buyers on the other side of any of these assets?
Well, that's right. And this is what I talk. That's correct. Now, this is what I talk about in chapter 4 of the book, how more and more assets under management have moved to passive investment styles.
Yes.
That means index funds and ETFs and things like that. Well, when passive investing started, when it began, I analogize it to like a mosquito lands on the back of an elephant. Well, the mosquito has a good time and the elephant doesn't even notice. So passive index funds were basically piggybacking on active investors who were committing capital, taking risk, and making markets, engaging in price discovery. And you could just kind of go along for the ride. But what happens when it's not one mosquito, it's a billion mosquitoes? The answer is the elephant dies. And that's what's happening in markets. More and more funds are going passive. Fewer and fewer are going active. Well, the active investors are the ones who commit capital and make markets. So you get into a financial panic with the passive investors. Their investors want their money back, so they have to sell stocks or sell assets or sell bonds to get money to pay the redemptions. Well, where are the buyers? Yeah, you've driven the active managers out of business. They're not going to be heroes like firemen rushing to a fire. They're going to walk away, and so the market's going to go no bid, and it's going to go straight down.
Thanks for tuning in. Remember, Jim Rickards' warnings emphasize the importance of understanding financial complexities. Act now, stay informed, and make smart decisions. Stay safe and stay informed. Until next time.